I get all the bullish arguments. You got the momentum. Earnings growth is good. Global reflation. The Fed is, drawing down their portfolio, but not by that much. However, the big variable it seems we have not talked about are rising interest rates, not bonds, but Federal Reserve's lending rate, which is obviously expected to go up even more. Is that the biggest risk to the market we're not talking about?
Well, I think it is interest rates, although I think it's real problematic if the bond market does in fact get involved, Brian. We've been hovering all year around that 240-ish kind of 10-year bond yield, and if it finally decides to reset, then I think it will be a challenge for the equity story. We're right now at a let's say a 240 10-year. It connotes lower for longer. But if you go up just, 25 basis points, 25 basis points, you're going to be at a fresh 3.5-year high in the 10-year yield. And suddenly, 25 basis points higher, the yield connotes the secular bond bull is over. And I do think we might have a shift in focus from Washington tax policy and the economy and earnings doing better to focused on overheat, inflation, is the Fed and bond vigilante behind the curve, and can the stock market, which now trades at 20 times forward one-year earnings, handle a bond yield, let's say, going from 2.5% back to 3%?
Can it? Answer your own question.
I think we'll get through a reset. I think we've got to reset the 10-year yield above 3% for the balance of this recovery. And I think as we do that, it's going to be a challenge for stocks. I expect a correction next year is likely, but I don't think it's necessarily the end of the bull. I think it'll be scary, but I think it might represent another really good buying opportunity for another leg sometime, let's say 2019 or beyond.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.